Wait, because it says it's connecting to the cloud server, but okay, so it's recording. Okay, so today, this week, I'm gonna do labor market part one. And then when we come next week, we have Thanksgiving break. And then we come back, we're gonna do labor market part two. Then we're gonna have the last chapter, which is gonna be chapter 32. It's about international trade. It's actually called Comparative Advantage and the Open Economy. That's the title of the last chapter. But so you know, it's basically international trade, explains international trade. And then the other thing that I'm gonna do for you guys is I'm gonna do a review. I'm also gonna post a review for the final. The final is comprehensive, so it's gonna cover everything, the material in chapter one, the material in chapter two, and labor market and international trade, which is the material after chapter two. And the final will be available, I believe the 10th and 11th. It's going to be Thursday and Friday. I wanted to have consistency. All the tests, whether it was test one, makeup, test two, makeup, everything was on Thursdays and Fridays. So the final will also be available the 10th and 11th. I know that the grades for us, okay, hopefully my internet will be stable. I've had problems this morning with the internet. The grades, usually for us, the due date is like the first week after the New Year's. So like the 4th of January or the 5th of January. Sometimes they even made it the 10th of January last year, I believe. What I will try to do is I will try to have the grades in by the 21st of January of December. Okay, so you're gonna have the grades in before the holidays and everything. You know, you're gonna have all the good news. You know, I want you to be happy. So that's the story on that. Both good news and bad news, exactly. You know, so you're gonna see. You're gonna, yeah. you're gonna be happy. I think you're gonna be happy. Hi, Kathy.
Hi.
Yeah, so basically I did the same thing that I did in, you know, kind of like going over what's going to happen for the rest of the semester.
Okay, thanks. Sorry I'm late.
So no problem. Okay, so like I said, Kathy, today I'm going to do labor market part one. After we come back from the break, I'm going to do labor market part two. And then the week after, we're going to do the last chapter, which is international trade. International trade, you're going to notice that it's the same chapter for both macro and microeconomics.
Oh, great. Okay.
Okay, folks, so let's talk about the labor market. I believe in the book, in the textbook, they have the labor market under two chapters, chapter 29 and 30. And basically, I can tell you that the material that I'm going to cover comes only from chapter 29. So you can just leave chapter 30 alone. I'm going to explain how come I'm only going to covering chapter 29, because chapter 20 has really become irrelevant as far as the labor market is concerned. So let me explain that right now. The book really separates the labor market into two. Competitive, so we have the competitive labor market. And non-competitive. Well, this is basically the competitive labor market is chapter 29. The non-competitive market, labor market is chapter 30. It's really hard nowadays to think of a non-competitive labor market. Well, competitive and non-competitive from what point of view? It looks at from the point of view of employers, okay? In other words, when there are many, 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 many employers, that's a competitive labor market. When there's only one employer, that's a non-competitive labor market. Remember when we talked about when there are many, many, many firms, we talked about a perfectly competitive or monopolistically competitive. But when there was only one firm that was supplying something, we called it, any ideas? How do we call only one firm supplying something?
Oh, monopoly.
Yeah, monopoly. Here, instead of looking at the firm supplying something, is the firm hiring. So the firm being the sole the sole firm that hires labor. Okay, if you are the sole purchaser of something, you would also be the same way. So it has a name. It's called a monopsony. So when you are the sole purchaser, in our case, you are the sole purchaser of labor, but you could be the sole purchaser of a product, then you, in that industry, you would be considered a monopsony. So a monopoly is the sole seller, and monopsonist is the sole purchaser. Okay, and in this case, we were interested in the sole purchaser of labor. Well, nowadays, it's very, very hard for me to think of any industry where there's only one firm that hires a profession. Okay, one firm that hires accountants, engineers, professors, taxi drivers, whatever. Okay, so just about every profession has many, 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 many firms that will hire them. Just think of any profession. You're in marketing. Well, there's going to be many, many, many firms that are hire marketing specialists. If you are a bartender, many, many places they hire bartenders. Probably maybe the closest that I can think of an industry where there's only one purchaser of labor might be the military. Where if you want to go into fighting or something like that, well, the military is going to be the ones. Even though that is changing nowadays because there are private contractors that are also participating in defense and war activities. So it's no longer just the military, because there are private militaries, if you will, that are competing with our military. So, but other than that, I cannot think of nowadays of where you can say that there's only one firm hiring that is available. Okay. Now, in the past, you could say that, let's say, a mining town. In a mining town, the mine owned every business. So the bank was owned by the mine. The grocery store was owned by the mine. The hotel was owned by the mine. The residential areas all were, so they were the sole hirers, the mine. Okay. Nowadays, we don't have that. Okay. So that's why I'm basically going to leave the non-competitive out, and I'm going to take a look at a competitive labor market. Now, most of the people in my classes are business majors. With the business majors, you would be with specializing in management, in business, in accounting, in marketing, in whatever, okay? Now, who determines the wage in the business market, in the business labor market? And the question is, well, there are many firms, and there are also many potential employees. So there are many business majors, and there are many firms that are hiring those business majors. So who determines that wage? Because what we're interested here in this class is who's going to determine the wage of those people, of the labor, and then how many employees a firm is willing to employ, because they're not employing employees willy-nilly. It's not going to be on a let's flip a coin and see whether we employ 20 or 30 or 50 or whatever. The number of employees that a firm is going to hire is the number of employees that is probably going to maximize their profits. So the same way we looked at, well, how many units of something a firm will produce, and they were not producing, whether it was a perfectly competitive or a monopoly or monopolistic competition, they were not producing a quantity that was random. They were producing a quantity that was specific, and it was the one where the Q star, where marginal revenue equals marginal cost, and therefore they were maximizing profit, or if they were taking losses, they were minimizing the losses. So you are producing a certain output that ensures either that you make the highest profits, or if you're taking loss, ensures the lowest losses. Well, the same here for the firm. How many employees will they hire? Well, they're going to hire to the point where the last employees ensures that if they make profits, they will make the highest profits. If they take losses, they will make the least amount of losses. Okay, so same principle. Okay, now, so let's start with the simple stuff. Who determines the wage of labor? Well, let's say that you got your degree in business. You are a business major, and you just got your bachelor's degree in business. Okay, now, who determines that? And what is that? And obviously, it's a little bit disingenuous to say, well, what's the going rate? What's the going rate for a business major? Because it could be, well, where did they graduate from? Did they graduate from this college, or did they graduate from Harvard? Obviously there's going to be differences. So we would have to narrow it down. We would have to narrow it down and say, well, what's the going rate for a business major graduate from San Diego State type university? Okay, that would be fair. We should not compare this university with that university. We know that the starting wages will be different. So we could say, well, San Diego State type university, like Arizona State or San Luis Obispo or stuff like that. So those are, kind of like middle level universities. And then somebody may say, well, okay, but what if you graduated with 4.0 and somebody else with a 2.0? It could be that then the wages will be different. Okay, so then we're going to narrow it down, and we're going to say, well, okay, so they graduated with a bachelor's degree in business with a 3.0 average. Okay. Same type of experience, and everything staying constant. Okay, well, who determines the wage? Well, if you look in the paper and you look at approximately how much the wage would be, what you should expect, you may find out that the going wage for a brand new business major is, let's say, it's $60,000. Okay, So $60,000. But who determined that $60,000? It's strange because in our minds, usually we associate that starting salary with how much the firm is actually willing to offer, right? But reality is, guess what? If the firm could get away with paying you whatever they are willing to pay you, how much do you think that they would give you? Absolutely. They would give you nothing. They would give you a loaf of bread and maybe half a bottle of water and say, okay, now you can work for about 16 hours a week, a day. And, so they want to pay as little as possible. On the other hand, if they would ask the people who are willing to work, the workers, the majors, the recently graduated majors, well, what do you think you should get paid? What do you think they would say? Oh, I should get paid a gazillion dollars. I want to get as much as possible. So who's going to determine the wage of those graduates? And the answer is it's neither the firm nor the graduates themselves. Is going to be a combination of firms and the graduates. The graduates now are the supply of labor, and the firms are the demand for labor. Firms demand labor, and we, as workers, we supply labor. So in the labor market, the wage is determined in the market by the forces of supply and demand. So here's the labor market for fresh new accountants, okay? And here's the supply of accountants, and here's the demand for accountants. Well, the equilibrium wage or the going wage for accountants is going to be the wage where there are no surpluses of accountants and there are no shortages of accountants. In other words, quantity supplied equals quantity demanded of accountants. And let's say that that is $60,000. Okay, now, folks, let's think about it for a second. I said that it's the forces of supply and demand that actually determine the wage for accountants. Let's see if that's the case. Folks, let's suppose the following, that for whatever reason, I don't know, but tomorrow, everybody, whatever their major, music majors, geography majors, engineering majors, mathematics majors, everybody decides to get into accounting. They're gonna major, they're gonna switch their major to accounting. Folks, if that happens, if everybody switches their major to accountants, what's gonna happen in the, first of all, what do you think is gonna happen to the wages of accountants, of fresh new accountants?
I'll go down.
It's gonna go down. Absolutely, it's going to go down because there's going to be a glut of accountants. Well, what changed? What changed that wage? It was a change in the supply of accountants. The supply of accountants went up, and as a result, the wage for accountants went down. So a change in the supply of accountants, if suddenly there are no accountants to be found. Nobody wants to major in accounting, and there are only a handful of accountants. Guess what? They're going to be able to demand a very high wage. So if the supply of accountants goes down, then the wage for those accountants is going to go up. Let's change something else. Let's suppose that the government decides to impose all kinds of financial constraints and all kinds of restrictions and stuff like that on businesses. And as a result, businesses now have to hire a lot more accountants than they used to because of those new constraints that are being imposed on businesses. Okay, so now businesses are looking crazy for accountants. What do you think is going to happen to the wages of accountants?
Up.
Up, absolutely. Why up? Well, because suddenly there's an increase in the demand for accountants. And the demand for accountants shifts to the right, and the wage for accountants is going up. So if the demand for accountants goes up, the wages go up. If the demand for accountants goes down, the wages go down. If the supply of accountants go up, wages go down. Supply of accountants go down, wages go up. So you see those changes in the relative shifts between supply and demand, that's going to determine what's going to happen to the wage of accountants. So it's not the firm, it's not the accountants, it's the interaction between supply and demand for accountants. That's going to determine the price. Okay, now let's say that the wage for accountants has been determined and it's $60,000. That's the going rate. That's the going rate. That's a normal rate for accountants, $60,000. Can anybody tell me if that's the normal rate of return for accountants is $60,000? If accountants are supposed to be made fresh new accountants, this is not PhD accountants, not CPA accountants, it's just bachelors of science or bachelors of arts accountants. Okay, fresh new. The going rate is $60,000. In economics term, let me ask you this. You know that the going rate is $60,000. And you just finished college and you did an interview with an accounting firm. And at the end of the interview, they extend their hand and they say, we would like to offer you a position with our firm, and we would like to offer you $60,000. You know that that's the going rate. Are you going to accept or reject?
Accept.
Accept. Because you are making a normal rate of return. You are making what you should be making. In economic terms, we would say that you are making zero economic profit. Okay? Zero economic profit means that you are making what you should be making. Now, if the going rate of return, if the going rate for an accountant is $60,000, that's what they're all offered. Everybody's offered $60,000. And the firm says at the end, congratulations, we would like to extend the position to you, and the salary is going to be $40,000. What should you do?
Consider influences? No, all right.
You should say
tough
bye-bye.
to walk.
Exactly. Good luck finding somebody working for $40,000 because everybody is offered
60.
So the firm offering $40,000, they should not be able to hire anybody because the going rate is $60,000. Now, if you are making $40,000 when everybody else is making $60,000, now you're making negative economic profit, and you should be getting out of it because you are making less than you should be making. Now, what if they offer you $100,000?
Well, you take it.
Oh, then you should be ecstatic because now you are making a $40,000 economic profit. You are making $40,000 more than you should be making. Okay. So this is the same like with the firms. When they were making zero economic profit, they're happy. When they were making positive economic profit, they were ecstatic. When they were making a negative economic profit, they were unhappy. Same with the employees. If they're making zero, it's perfectly fine because you're making what you should be making. If you're making negative, that means that you're making less than you should be making. And if you're making more, well, then you should be ecstatic. But obviously, if they're offering $100,000, then the firm is not maximizing their own profits because they're offering you too much money. They could get away with giving you $60,000. They're giving you $40,000 on top of that.
Yeah, well, they'll recognize the error of their ways.
Well, maybe, I would always, let me tell you, if I would always prefer that the firms offer me too much and then they adjust it later, than offer me too little and then I adjust it later, you know, because when you start off too little and they say, oh yeah, we're gonna adjust it, don't worry about it. You know, I was in a position a long time, and you know what? I never caught up.
Yeah.
Okay. So let's take a look at the firm now. Let's take a look at the firm. We looked at the industry. Who determines the wage in the industry for whatever profession? It's actually the market. There's the supply and demand. And then the firm is a price taker. They take the price in the market and they offer that price. So for example, you start out your own business. It's let's say you audit businesses, you audit other businesses. And you need to hire accountants or business majors or whatever. And you're looking at hiring those accountants. And you hire the first accountant. Question for you, how much you gonna offer if you wanna hire your first accountant? Okay, you scared me, Andrea. So what's the going rate? How much you need to offer to hire an accountant?
The going rate.
What is it?
Oh, it's 60,000.
Ah, thank you. I was like, they already forgot?
Okay.
$60,000. Okay, so at $60,000, you hire the first accountant. You offered 60,000, you hired the first accountant. Let's suppose that you want to hire a second accountant. How much you gonna offer? It's okay, simpler than you think.
60,000.
60,000. A third one. 60,000.
Okay.
In a competitive market, there are many firms that are hiring those accountants. That means that what can we say about the size of those firms? They are very small. So there are small firms hiring a bunch of accountants. In other words, each firm can hire as many accountants as they want at the going rate for the accountants. Why don't they have to offer a higher wage in order to hire additional accountants? Because they are small firms in the whole market for accountants. So as a result, they can hire as many people as they want at the going rate. They are only a small firm in the whole market for accountants. So they can hire as many as they want at the going wage for accountants. Well, the wage of the first accountant is $60,000. The wage of the second, $60,000. The third, $60,000. The fourth. What are those wages? What are those wages to the firm? Is it a revenue or a cost? Those wages. It's a cost. It's a cost. So here on this axis, we're looking at the quantity of labor. The quantity of labor, and here are the costs. On this axis, we're measuring the quantity of labor. So you tell me, what is the contribution to the cost of the first accountant? The contribution to the cost of the first accountant?
100%.
Well, what is 100% in terms of
a single salary, 60,000.
$60,000, good. The contribution of the first accountant to the cost is $60,000. And the contribution of the second accountant to the cost is?
Same, 60,000.
Third, same. Fourth, same. How do we call the contribution of a unit to the cost? The contribution of one unit starts with M.
Marginal.
Marginal. And this, because we're talking about cost, this is going to be the marginal
cost.
Cost, exactly. So this graph over here represents for the firm the marginal cost the marginal cost curve, I'm sorry. So this is marginal cost, this line here, that is the same as the price that you're paying for an accountant or the wage of an accountant, $60,000. This represents the marginal cost because it shows how much this accountant cost you, this accountant cost you, how much this, the third one contributed to the cost, how much the fourth one contributed to the cost. All of them contribute the same amount to the cost, is $60,000. So normally, I would label this curve the marginal cost curve. So it will be MC. But that's how we called it when we talked about the product market. How many units are you producing? The first one, the second one, the third one. Well, the marginal cost curve shows us how much each unit contributes to the cost. Now here we are looking at how much each unit of input, how much each accountant contributes to the cost. We're looking at labor. And because of that, we're going to give it a slightly different name. Instead of just calling marginal cost, which it actually is, it is marginal cost for the firm. We're going to call it MFC. And I'll give you the definition in a second. It's marginal cost, but that F represents marginal factor cost. In other words, it says that it's marginal cost of a factor of production, in particular labor. Okay, but it's marginal cost, you know, but they just want to change names so that confuses a little bit. I don't know why. Okay, now remember, now we already know that the firm has no control over the wage. They are a wage taker. They are a price taker here. They don't, they cannot offer, well, they can offer more, but they would be dumb. And they cannot offer less because they cannot hire anybody. So they got to offer the going wage, which is determined in the market. So the firm doesn't have control over how much they're going to offer each worker, each accountant. That is determined by the forces of supply and demand, is determined in the accounting industry. The question is, how many workers will they hire? How many accountants will they hire? And for that, again, we're going to make an assumption to determine how many accountants the firm will hire. We're going to make the same assumptions that we made under the product market when we were trying to determine how many units should the firm produce. And in that case, when we were determining how many units a firm produces, we made an assumption that one factor of production, labor, is a variable. It can vary, but the other one, the cost, is fixed. Okay, so well, the other factor of production, I should say, the other factor of production, capital, is fixed. Remember how I gave you the example about the McDonald's. You know, when you think of a McDonald's, in your mind, you can make it a big one, a small one, or a medium-sized one. But once you build it, you're stuck with the size of the building. You have so much space. Okay, the same is going to be here. When you open up your business, you can open up a big business, or a small business, or a medium-sized business. But once you open it up, the size of the office that you have, that's going to be determined, that's going to be fixed. You cannot change that. Okay, so you can hire more or fewer workers, but the size of the office is going to be fixed. So capital is fixed, labor is variable. Okay, so folks, let's suppose that first thing that I do before I open up a business, I find a good location for my office, and I sign a lease on this office. It's a nice office. And then I have to hire an accountant to do the audits. So I hire my first accountant, and my first accountant is able to do, let's say, 10 audits in 1 year. Okay, So the accountant is doing 10 audits in 1 year. Should I hire that accountant? Yes or no? And the answer,
Yes.
well, I don't know.
Oh,
How come? Because they are contributing to me 10 audits. They are able to do 10 audits. But I want to know how much is 10 audits in terms of
average productivity?
I know how much I'm paying them. And I know how much they're going to produce.
Oh, your variable costs?
No, think about it. Think this way. They are producing 10 audits in 1 year. How much am I paying them per year? How much am I paying them per year?
60,000.
60,000. But they are producing 10 audits. What do I need to know in order to determine whether it's worth hiring this person or it's not worth hiring this person?
You get more than 6,000 an audit?
Ah, very good. So I know that it's 10 audits. So now it would help if I need the price of an audit, how much I charge for an audit, right?
Right.
The price of an audit times the number of audits is exactly how much money is coming in. Let's suppose, so now I'll give you the example, but more complete. The first accountant is going to contribute 10 audits in 1 year, and each audit is bringing in, the price of an audit is $10,000.
Okay.
What is the contribution of that accountant to my revenue? In other words, how much money do they put into my pocket, regardless of the cost that I have, regardless of the wage? How much money they're bringing in?
100,000 gross.
$100,000, exactly, $100,000. So they're bringing in $100,000. And how much are they taking out of my pocket?
60.
My pocket. Yeah, exactly. This is the $60,000, the wage that I'm paying them. So they're bringing in $100,000 and they're taking out $60,000. Would you hire that accountant?
If we don't need more information, then yes.
Yeah, absolutely. With the information that we have, they're bringing in 100,000 and they're taking out 60,000. Of course, we're going to hire them because they're going to put $40,000 in our pocket. So the first person contributes $100,000. Now, this business is profitable, right? So if the business is profitable, what am I going to try to do?
More business.
More business, exactly, more business. So I'm going to hire a second accountant. Now we have a little bit of a problem. Now, we know how much I'm going to pay the second accountant. It's going to be $60,000, right?
Yeah.
Okay, good. But guess what? I only have that office available. And when I had one accountant, I was able to put in that office one computer, one desk, and one accountant. Now I got to bring in a second accountant, but I got to put the second accountant in the office with the first accountant.
Ooh.
So now, yes. So now I'm squeezing them in there. So they're going to have to share the computer.
Uh-oh.
Yeah. Now, question for you. Now that they have to share the office and they have to share the computer. Okay. So the capital is fixed. The labor is the one that's variable. So now they're sharing the computer. When one accountant was in there, they were able to produce 10 audits. Now that I'm squeezing a second person in that same office on the same computer, do you think that two of them will be able to produce 20 audits?
No.
No. The number of audits will certainly go up, but it will not.
It won't go up proportionately.
Exactly. It will not double, right? So now let's suppose that those two accountants are able to produce 18 audits.
Okay.
That means that if with one accountant, we produce 10, and with two accountant, we produce 18.
Well, it's okay then. You're at what it was at 180 versus 120. So you still have a net of 60K, which is more than your 40K.
Right, don't go so fast.
Okay.
So with one accountant, I'm producing 10. With two accountants, I'm producing 18 audits. We could say that the second accountant contributed how much in terms of audits? Just because I brought the second accountant in, by how much did my number of audits go up?
80K.
Okay, 8 audits or 80K in terms of revenue, absolutely. So the second accountant contributed $80,000 to my revenue. Folks, they contribute $80,000 to my revenue. How much did they contribute to my cost, the second accountant? How much did I pay?
Go ahead.
How much did I pay? How much did I pay all my accountants? Come on, we talked about that number over and over. Each accountant, how much do I pay them?
$60,000.
$60,000. Don't we agree that you can hire as many accountants as you want at $60,000? That's the going rate. So the first accountant 60, the second 60, third 60, fourth 60, fifth 60, and so on. So question now is, the first accountant contributed 100 to the revenue, 60 to the cost. I said, okay, we're gonna hire. You said it. The second accountant contributes 80,000 to the revenue, 60 to the cost. Do we hire that accountant or not? 80 to the revenue, 60 to the cost. It puts $80,000 in my pocket. It takes $60,000 out of my pocket. Is my pocket getting fatter or slimmer? Are they putting more money in my pocket than they're taking out, or are they taking out more money than they're putting in? Okay, let me ask you this. If I say to you, you pay me $60,000 and I'm going to give you $80,000, would you hire me, yes or no?
No.
So if you pay me $60,000 and I give you $80,000, you would say no.
No.
Yes, I'll say yes.
Because I'm contributing to you how much?
Is my microphone working?
Okay, how much am I contributing? If I'm giving you 80,000 and you're giving me 60,000, how much richer are you going to be?
$20,000.
$20,000, exactly. So would you hire somebody who's going to give you $80,000, but is going to take from you $60,000?
Yes. Yeah.
Of course. If they put more money in your pocket than they're taking out of your pocket, you're going to hire them. If I say to you, listen, give me $2 and I'll give you $3, would you turn me down?
Yes.
Why?
Last one.
No. I said,
I'll hire you.
No. Rana, I said, if I ask you for $2 and I give you $3, so if I'm taking from you $2.
Yeah, I get it now. Yeah.
Okay. So of course.
Definitely, yeah.
As long as somebody contributes more to me than I contribute to them, I will want to hire them because they're making me richer. Well, let's take a look. What happens here. What are those numbers? 100,000, 80,000. What do they represent? They represent the contribution of each worker to the what? Anybody? It's the money that they're bringing in. So the money that they're taking out is marginal cost, the contribution of each worker to the cost. How do we call the contribution of each worker to the money that's coming in? What is the name for that? Starts with an R.
Revenue.
Revenue, exactly. So the contribution of each worker to the revenue is going to be marginal revenue. So marginal revenue is going to be this line here. Folks, what I said is that we're going to hire workers for as long as they contribute more to the firm than the firm contributes to them. In other words, as long as marginal revenue is greater than marginal cost, we're going to hire those workers. And as soon as marginal cost is greater than marginal revenue, we're no longer going to hire those workers, because if marginal cost is greater than marginal revenue, that means that the firm is putting more money in the pocket of a worker than that worker is putting in the pocket of the firm. So it makes no sense for me to hire a worker that, for example, contributes $50,000 to the firm, and the firm is paying the worker $60,000. So how many workers are we going to hire? We're going to hire up to this point here, where marginal revenue equals marginal cost. That's the profit maximizing quantity of labor that we're going to hire. So in my example, let's say that after I hired the second worker, now I'm thinking of expanding even more. If I'm thinking of expanding even more, I hire a third person. I'm going to pay them $60,000 because that's the going rate for an accountant. But since all three people are now sharing that office and the computer, their productivity decreases. So now it goes from 10 with one worker to 18 with two workers and to 24 with three workers. Well, if that's the case, that means that the third worker contributed, well, going up from 18 to 24, that's 6 audits. And in terms of money, it's 6 audits times $10,000 is $60,000. $60,000 right here. And I contribute to them $60,000. They contribute to me $60,000. That's going to be the last person that I'm going to hire. Yes, Kimiko, say.
Well, I'm sorry.
Oh, okay.
That's like a marginal cost meets the revenue.
So
zero.
Yeah, you need marginal cost. You hire to the point where marginal cost equals marginal revenue. Just as in the product market, where how many units we were producing to profit maximize, where marginal revenue equals marginal cost. As long as marginal revenue was greater than marginal cost, we kept on producing. And we stopped at a point where marginal revenue was equal to marginal cost. We didn't go past that point because it made no sense to produce a unit that contributed more to the cost than to the revenue. The same here in the labor market. We're going to hire workers as long as they contribute more to the revenue than to the cost. More to the revenue than to the cost. And I'm going to go all the way up to the point where the last worker contributes just as much to the revenue as to the cost. And I stop there. That's where I profit maximize or I loss minimize. If I'm making profits, I'm going to make the maximum. If I'm making losses, I'm going to make the least amount. I'm not going to go to the fourth worker because as you see, you notice the contribution of the fourth worker to the cost is going to be $60,000, but the contribution of the fourth worker to the cost is going to be less than $60,000. Let's say $50,000. I'm not going to hire that worker. So I'm going to stop here. So the Q star for labor is going to be very similar to the Q star in the product market. So the Q star for labor is where marginal cost equals marginal cost equals marginal revenue. The only difference is here, the names are going to be different a little bit. Marginal cost is going to be marginal factor cost, and marginal revenue is going to be marginal revenue product. But marginal factor cost is the same as marginal cost, and marginal revenue product is the same as marginal revenue. But it's just that that's a different name for it in the labor market. Okay.
So excuse me. So it's the same like when you said before about like shut down or stay in the business, or is it the same?
No.
Oh.
Remember, at this point, with the labor market, the only thing that we're going to determine is what is that Q star. We're no longer going to make a decision whether we shut down or not. You can only make decisions whether you shut down or not when you talk about the product market.
Yeah.
Okay. But if you talk about the labor market, let me explain for a second what it means. When I talk about the labor market and I find this Q star here, this represents how many workers I should hire to get to that Q star that we were talking in the product market. Remember Q star, where marginal revenue equals marginal
Yes.
cost?
Yes.
Well, okay, so we needed that Q star. Well, we need this Q star in terms of labor to be able to produce Q star in terms of products.
Oh, okay.
Okay, whether we are making a positive profit or a negative profit, I don't know. So that's why I cannot talk about whether we're going to shut down, we're going to stay in business, whether we make a profit or we make a loss. I don't know, because it's like this. Let's say.
Is this mean like the first step to move to another step?
Well, no, they're actually they you can use them that way, or you can make them independent. I don't want you to get too much involved in this.
Okay.
Basically, it's like this. Let's say we have a perfectly competitive firm. Marginal revenue, marginal cost. We need to produce here. That's the output. That's the output number of units that will ensure if we make a profit, maximum profit, and if we make a loss, the least amount of loss. So we want to be over there at Q star. If you look at the labor market, separately, you would say that if we hire this Q star amount of labor, then we're going to be able to produce that Q star amount of units. But unless I have here average total cost, average variable cost, and all that good stuff, I cannot make a decision. I don't know whether it's making a profit or a loss or stuff like that. But I know that if I hire Q star units of labor, I'm going to be able to produce Q star units of output.
Okay.
That's the whole.
Thank you. Yeah.
So in other words, but remember that you always want to produce this Q star. You want to be there, because if you're making the positive profits, you're making the maximum. If you're making, of course, if you make negative profits and you should shut down, you can only determine that here in the product market. You cannot determine that in the labor market. The labor market all it tells you is that you're going to be producing, if you hire Q star units of labor, you're going to be able to produce Q star units of output. That's all. Yeah. But nevertheless, the whole idea is that we can determine, in order for us to be able to produce Q star units of output, using the labor market, we can determine what is the number of workers that a firm needs to hire in order to be able to produce this star, this Q star units of output. Okay. Okay. So no, in the labor market, you're not going to have to determine whether you are making a profit or you are making a loss. No, that's not going to determine that. You are not going to determine whether you should shut down or stay in business. No, because for those decisions to be made, you need the price of the product, you need the average total cost of the product, you need the average variable cost of the product. That's given only in the product market, not in the labor market. In the labor market, you only determine how many workers I need to hire in order to be able to produce the profit maximizing, loss minimizing output of labor. Okay. All right. So for now, I think this is good enough. I don't want to stretch it way too much, confuse you too much. I'm going to do, when did I say? I said, maybe I'll have lecture on Wednesday with part 2. So if I have lecture on Wednesday with part 2, what I will do is when we come back from Thanksgiving break, I'm gonna give you some problems and we're gonna work out some problems on the board, and it's gonna be just problems on the board after this Thanksgiving break. So remember, I started out the class saying, well, let's do this week part 1 and in 2 weeks part 2. Let's do this week part 1, also on Wednesday part 2, and then when we come back, we're gonna do maybe like a review of this and some problems. Okay, so
yeah,
that way we. Go ahead.
Yeah, sounds good. Very
okay.
good. Yeah, much better.
Okay. Yeah.
I have a question. It's not the same as what you said about information, but I like what you said about like information. You spread the information, because I take before like a class economy, I lost a lot of points. But actually, if I need to back after the semester finish, I can back to see your lecture and YouTube. I'm trying to do it today in the morning to see like reach your lecture in the YouTube, but I didn't find it. Is that under your classes, or I need to back after like December 14 to back to see each one and take a lot of note, because I like your way about your information. This is the reason. How can I reach this videos? It's not allowed to see it in the YouTube?
You should be allowed to see in YouTube, but I don't know what the keyword searches would be.
Yeah,
to find.
I did found it. This is the reason. I'm tried many times in the morning, but I didn't find it.
Yeah, I don't know what the keyword searches are. So
also no option for download. This is the reason. Yeah.
Well, you mean from Canvas to download it onto your computer?
Yeah.
To be honest, I never had anybody so enthusiastic about my
I'm
lectures.
to back to study and take a lot of notes. I will keep this information with me, because in the future for business or it's very, very nice way you explain this information. So the reason.
Well, thank you. But yeah.
Anyway,
I don't know. There probably is a way. I'll look to see how I can
if you don't
search
mind.
for
Yeah.
my videos on YouTube.
Yeah,
And if you
thank
can
you.
find them on YouTube, then you can definitely download them off of YouTube.
I appreciate. Okay, thank
Uh-huh.
you. See you Wednesday.
Okay, see you guys on Wednesday.
Wednesday, 1 o'clock.
Yes.
Thank you.